Richard retired when he was 62. He had spent 3 decades doing what most people say they want to do, but never fully manage: saving consistently, planning ahead, and staying disciplined. By the time he left work, he had built a traditional IRA worth about $600,000. He also had a plan. He knew that the early years of retirement could create a valuable tax opportunity. His wages were gone. His required minimum distributions had not started yet. His taxable income was lower than it had been in years. So he decided to use that gap to move money from his traditional IRA into a Roth IRA. The strategy made sense. Pay tax now while rates are low. Move money into an account that can grow tax-free. Avoid larger tax problems later in retirement. He had done his homework. He had read articles, watched videos, and talked to his advisor. Over 2 years, he converted $180,000 from his traditional IRA into a Roth. He even paid the taxes from cash savings so that the full amount could stay inside the Roth and continue compounding. Everything looked smart on paper. Then he turned 65. He enrolled in Medicare, expecting the usual premium most retirees talk about. Instead, he got a notice telling him that his Medicare Part B premium would be far higher than the standard amount. Rather than paying $202.90 per month, he and his wife were each paying $443.10 per month. That meant thousands of dollars in extra cost for the exact same coverage. And the cause was not current income. He had not worked in years. The reason was income from 2 years earlier, specifically the Roth conversions he completed at age 63. That is the part retirees miss. They think once the tax is paid, the decision is over. But for Medicare, it often is not over at all. This is where many retirees get blindsided. They make a financially reasonable decision, but they make it during the wrong year. The result is a Medicare surcharge they never expected. This video is for education only and not personal tax or financial advice. Always talk with a qualified tax professional before making decisions for your own situation. My name is Kevin Retires. On this channel, I break down retirement taxes, Medicare traps, and planning strategies so you can avoid the expensive surprises too many retirees only discover after the damage is done. Today, I want to explain why age 63 matters so much. I am going to show you how Medicare's 2-year look-back works, why Roth conversions and other income events can increase premiums, and what action steps make sense depending on your age right now. Most retirees know Medicare Part B has a monthly premium. What they often do not know is that not everyone pays the same amount. Your premium can increase based on income, and not your current income. Medicare looks back 2 years. That means your 2026 Medicare premium is based on your 2024 tax return. If you first enroll in Medicare at 65, your first premium is generally based on the income you had at age 63. That is why 63 becomes such an important planning year. In 2026, the standard Part B premium is $202.90 per person per month. If your modified adjusted gross income is at or below $109,000 for single filers or $218,000 for married couples filing jointly, you pay that standard premium. But once income rises above those thresholds, Medicare adds what is called IRMA, the Income-Related Monthly Adjustment Amount. And IRMA is not gentle. It works like a step function. If your income goes above the line by even $1, you move into the next bracket and pay the higher premium for the full year. Here are the 2026 Part B amounts. At the base level, the premium is $202.90 per month. If income rises into the first IRMA bracket, the premium becomes $284.10 per month. The second bracket raises it to $365.60. The third bracket pushes it to $447.10. The fourth bracket makes it $528.60, and the top bracket takes it all the way to $689.90 per person per month. For a married couple, that difference can mean many thousands of dollars per year. Same doctors, same coverage, same Medicare, higher premium, simply because of income from 2 years ago. That is why Roth conversions at 63 can create a problem. Even if they make sense from a long-term tax standpoint, they may still raise Medicare costs at 65. Let's look at how this happens in real life. Take David. He is 63 and retired at 61 after a long career in manufacturing. He has a traditional IRA worth about $420,000 and a small pension that covers most of his monthly expenses. This year, because his taxable income is low, he decides to convert $120,000 to a Roth IRA. After adding in the conversion, his MAGI reaches $139,000. That puts him above the first IRMA threshold for a single filer. 2 years later, when he starts Medicare, he does not pay the standard premium. Instead, he lands in a higher tier and pays $365.60 per month. That is an extra $162.70 every month. Over a year, that is $1,952.40 in additional Medicare premium. And because the look-back applies again the next year based on the following tax year, the total cost across the first 2 years of Medicare can approach $4,000. Now, maybe David still benefits from the Roth conversion over the long run. That might be true. But if he had converted earlier or spread the conversion out more carefully, he might have achieved the same goal with less Medicare damage. Now consider a married couple, Sandra and Thomas. They are both 63. Sandra still earns part-time consulting income. Thomas receives Social Security. This year, they also sold appreciated stock and took a small IRA withdrawal for a home expense. Nothing felt dramatic to them. They were not trying to trigger anything. They were simply using their money. But when all of those items are added together, their MAGI reaches $245,000. That is above the joint threshold. 2 years later, both of them start Medicare, and each pays $365.60 per month for Part B. Compared with the standard premium, they are paying thousands more per year. That is how people get hit. Not always by one giant event, sometimes by several normal decisions that happen in the same tax year. A stock sale, a Roth conversion, an IRA withdrawal, consulting income, or extra investment gains. Now compare that with Margaret. Margaret is also 63. She is a retired nurse. She has no large IRA, no big capital gains, and no Roth conversion strategy in motion. She has a pension and Social Security, and her income is around $64,000. When she enrolls in Medicare at 65, she pays the standard premium. For Margaret, age 63 is not a high-risk planning year because her income never gets near the IRMA thresholds. And this is important. Not every retiree needs to panic about IRMA, but retirees with tax-deferred accounts, brokerage gains, rental income, or other controllable income sources absolutely need to pay attention. Because if you have flexibility, then timing matters. And at age 63, timing matters a lot. What makes this even more complicated is that age 63 is not just about IRMA. 3 different systems can all be pulling on your income at the same time. First, there is the tax system. Many retirees in their early 60s are in low-income gap years. They have stopped working, but have not yet started required minimum distributions. That often makes Roth conversions attractive. Second, there is ACA health insurance. If you retire before 65 and use marketplace insurance, your subsidies depend on MAGI. Higher income can reduce or eliminate those subsidies. That means a Roth conversion could cost you not just in taxes, but also in health insurance assistance. Third, there is Medicare IRMA. So at 63, one system may encourage you to create income, another may reward you for keeping income low, and a third may punish high income 2 years later. That is why generic advice can be dangerous. Convert while your income is low is not necessarily bad advice. It is just incomplete. The right answer depends on how much you are converting, what your current income is, whether you are on ACA coverage, how large your traditional IRA is, and whether future RMDs are likely to create even bigger problems later. That is why the timing window matters so much. If you are 60 or 61, you may still have a cleaner Roth conversion window. Income from those years may be behind you by the time Medicare starts. If you are 62, you are getting closer to the critical years and should start modeling income carefully. If you are 63, every major income decision deserves a second look. If you are 64, the same logic still applies because that year affects your second Medicare year. And if you are already on Medicare, the game is not over. IRMA keeps following your tax returns every year through the 2-year look back. Some retirees ask whether they can appeal IRMA. The answer is yes, but only in certain cases. If your income dropped because of a qualifying life-changing event, such as retirement, reduction in work, divorce, death of a spouse, loss of pension income, or loss of income-producing property, you may be able to file Form SSA 44 and ask Social Security to use more recent income. But if the higher income came from a deliberate Roth conversion or a planned sale, that usually does not qualify for appeal simply because you regret the timing. That distinction matters. Another issue people often ignore is what happens after one spouse dies. While a couple files jointly, they benefit from higher IRMA thresholds. But after one spouse passes away, the survivor eventually files as single. The thresholds are cut in half. That means the same income that created no IRMA for a married couple can create a large surcharge for a surviving spouse. This widow penalty is one reason Roth conversions can still be valuable before that happens. Moving some money into Roth while both spouses are alive may reduce future taxable withdrawals for the survivor and help keep Medicare premiums lower later. So, what should you actually do? If you are in your early 60s, stop treating Roth conversions as a simple yes or no decision. They are a timing decision. Before doing a conversion, selling appreciated stock, taking a large IRA withdrawal, or realizing significant extra income at 63 or 64, estimate your magi and compare it to the IRMA thresholds. Do not look only at tax brackets. Look at the Medicare consequences too. Sometimes crossing the line is still worth it. If the long-term tax savings are big enough, paying higher premiums for a year or two may still make sense. But you should know that before acting, not after the notice shows up. That is really the heart of this issue. The law is public. The numbers are available. Medicare is not hiding the rule. The real problem is that many retirees are never told how urgent age 63 becomes. They hear about tax brackets. They hear about Roth strategies. But no one puts the timeline together and says, this is the age where Medicare starts paying attention. And because no one explains it clearly, people make smart moves in the wrong year and end up paying more than they needed to. Richard's story is not unusual. His Medicare premium eventually fell back down after the look-back moved to lower income years. The surcharge was temporary, but temporary does not mean harmless. It still cost real money, and in many cases, it could have been reduced or avoided with better timing. That is the lesson. In retirement, strategy matters, but order matters too. The right move at the wrong age can still be expensive. If this helped you understand something you had not seen clearly before, share it with someone in their early 60s, especially if they have a traditional IRA and are thinking about Roth conversions. Because once you understand how age 63 works, you can plan around it. But if you only learn about it after enrolling in Medicare, then you are learning too late.